Trading the news. In this video, you'll learn what moves the market, whether to trade or not to trade the news, proactive trading, and reactive trading. It is with no doubt that news and economic data releases move the market. This particularly applies to the Forex market because changes in the economic situation directly affect the demand and supply for the currency. After all, currencies are essentially confidence indicators for their countries. News releases provide fresh information on the performance of an economy, and data surprises can sharply affect the market. This is the reason why one of the most popular ways to trade Forex is to trade economic data and news releases. Now, although trading the news can be exciting, it is also very risky due to the volatility that can be triggered by the news releases. When trading the news, first you have to know which releases are expected for the week and which are the more important data. Generally speaking, the most important economic events and releases are central bank meetings for interest rate, Consumers' Price Index and Producers' Price Index for inflation, Gross Domestic Product, Trade Balance, and Retail Sales for growth, Unemployment Rate and Non-Farm Payroll for the labor market, Consumer Confidence Surveys for market sentiment, and earning releases for companies' profits if one is trading shares. Depending on the current state of the economy, the relative importance of these releases may change. For example, unemployment may be more important this month than trade or interest rate decisions. Therefore, it is important to stay on top of what the market is focusing on at the moment. Traders are divided into two opposing groups whenever the question of trading during news releases comes up. The first group, which represents approximately 50% of all traders, believe that the news releases will affect the markets in unexpected ways, i.e., causing huge volatility in either direction, so they will avoid trading around the news releases by making sure that they do not have any open positions. The second group, which represents the other 50%, believe that their analysis of the past market data already discounts the upcoming changes, and therefore there is no reason for them to stop trading during future news releases. Whether you should continue trading through news releases or not depends upon how these events affect your trading system. If your trading system is based upon something that the news can affect, such as the range of the most recent candle, then perhaps it might be wise not to trade during news releases. Whereas, if your trading system is based upon something more insulated from the news, such as a price pattern that involves several candles, then you may be able to trade through news releases unaffected by any market reaction. Economic releases can be traded either proactively or reactively. Trading proactively involves taking an educated guess on whether the data will positively or negatively affect the market and place a trade accordingly. On the other hand, trading reactively involves placing a trade after the economic data is released based on the real outcome. This removes the guesswork, but also any advantageous knee-jerk reactions. Forecasting the upcoming data release results is not as difficult as it may seem. For instance, to forecast employment data, one should look at the employment subcomponent of the PMI, Purchasing Managers' Index Report, which is usually released prior to the official employment report. To forecast retail sales data, one should look at the confidence and sales components of the PMI report found under the Services section of the report. To forecast Consumer Price Index data, one should look at the Producer Price Index report, which measures inflation on a wholesale level and is typically reported prior to the consumer prices. Forecasting economic data is not easy, but a master's in economics is not needed either, just some common sense. Try it for yourself, and if you still find it challenging, there is always reactive trading. Reactive trading rules out any form of prediction or anticipation. The reactive approach calls for a quick reaction from the trader as soon as prices start to move. To beat the crowd, reactive traders put their utmost focus on the correct timing by applying one of many strategies. With the hedging strategy, traders would position themselves on both sides of the market. This strategy consists of going both long and short at the same level before the release of the economic data. Action is not taken until after the number is released. Once the number comes out, the trader must close the two-legged hedge position by taking both a profit and a loss. If the data was favorable, the trader will first take profit on the long position. This enables him to allow the market to correct after it made the initial reaction to the release, and then close the short position with a smaller loss. If the number released was unfavorable, the same strategy can be applied where the trader takes profit on the winning short position first, wait for a correction, and then trade out of the losing long position with a smaller loss. A variation of the hedging technique is the straddle technique, and it requires using pending orders. Usually markets become slow and stagnant before important announcements, so few minutes before the news release, the trader should find the trading range on an intraday chart, usually the 5 or 15 minutes time frame, and place a buy pending order of 5 to 10 pips above the top of the range, and a sell pending order 5 to 10 pips below the bottom of the range. The buy order should be accompanied by a stop-loss order a couple of pips below the range, and the sell order should be accompanied by a stop-loss order a couple of pips above the range. The next thing is that as soon as one of the pending orders is triggered, the trader should instantly cancel the opposing order. The stop-loss order should be in the form of 20 pips trailing stop-loss, allowing for an automatic trail to the break-even or entry level as soon as the position goes to 20 pips in profit. Then, for every additional pip in the favorable direction, the stop-loss continues to move, further locking in more profitable pips. Always keep in mind that trading the news is not always profitable, and sometimes the market hits our stop-loss before having the chance to trail our position. Good money management and proper position size is always the key. The post hoc strategy is based on the fact that once the market has absorbed the news release outcome, it usually glides in one preferred direction. Following this technique, the trader should wait around 10 to 20 minutes after the release and then take action by entering a trade in the preferred direction of the market. The initial directional price wave is often followed by a corrective retracement as a result of some profit taking. After a big reversal candle in the direction of the initial move, the trader should open the new position and place the stop loss below the bottom point of the retracement. This method has the advantage of not putting the trader to the emotional drain that can result from other news trading strategies and provides a relatively better risk-to-reward ratio. News-based trading offers some distinct advantages compared to other traditional trading approaches. Almost every week, there are key market-moving events that offer potential trading opportunities for traders. Many websites offer free-to-use economic calendars that can be filtered based on the currency and the importance of the event. XM offers its clients a distinguished calendar that can be found on its website, www.xm.com. The biggest benefit of news trading is that it allows the trader to capture volatile price movements in a short period of time. News can act as a catalyst for prices. Trends may be in pause mode, and then news comes out and propels prices. It does not require a lot of screen time. The trader needs to be available 5 minutes before the news release and 30 minutes to an hour after the data release. News trading is very attractive since it allows traders to capitalize on big market moves in a short period of time. But at the same time, it comes associated with serious risks. Extensive market uncertainty around news events promotes the spreads to widen significantly, causing traders to endure increasing trading costs. Extreme volatility during these events can sometimes cause significant price slippages and gaps. This can result in the trade being filled at a far different price. Stop-loss hunting is a common phenomenon associated with news events. Institutional traders with massive orders to fill will push prices to where orders are clustered, wiping out retail traders' stops along the way. Sometimes news will bring just volatility and no distinct direction. Oftentimes the market may start off flying in one direction, only to be whipsawed back in the other direction. Profitable as it may be, trading the news isn't as easy as you may think. It will take loads of practice, and, you guessed it, more practice before you are ready to attempt it in live markets with real funds. Thank you for watching.